All right, last time we talked about the basic types of securities and terminology. We ended up talking about asset classes. Three major asset classes are cash, fixed income, and equities. And in this segment, we're going to look at cash. What is cash? Cash are any securities or all securities that do not go down in nominal value. That's an important term to know. Nominal value. Nominal means the quoted amount. So the nominal value of a dollar bill is $1. The nominal value of $100 is $100. If the $100 I put in the bank becomes $110, my nominal value went from 100 to 110. Nominal is distinguished from real. We talked about that in economics. Right? Just because my security does not go down in nominal value, it can go down potentially in real value. Why? Because if I keep $1 today and 10 years from now somebody gives me that dollar back, it's not worth as much. Nominal value is exactly the same, but real value is much lower. But cash is defined as securities that do not go down in nominal value. How do you get money from those kinds of investments? Well, they pay interest. Think about going to the bank. You put your money in a savings account. What do? They give you interest. You get your money back plus interest. Now, let's talk about money market instruments. Money markets are short-term debts that mature within a year. That sound familiar? Right? Current liabilities. Examples are U.S. Treasury bills. You should note U.S. Treasury bills have a very important role in finance. They're known as the risk-free asset. Treasury bills. Treasury bills are U.S. government borrowing money and promising to pay back within a year. Why are they risk-free? Because pretty much our government's going to be around a year from now. If not, we're in a whole lot bigger trouble. So, but because they're risk-free, they also pay very low interest. But that's what U.S. Treasury bills are. They're simply the U.S. government borrowing money and promising to repay it back within a year. Banks offer certificates of deposit, CDs. It's just like putting your money into a savings account at the bank. The only difference is you promise to keep it in there for a longer period of time. 30 days, 90 days, a year. If you agree to keep it in there and not take it out, the bank will give you a little higher interest rate. But you get your money back, plus interest. That makes them cash. Right? Makes them cash. You may have heard about money market funds, a money market fund. Well, first of all, a fund is a group of investors getting together and pooling their money to buy stuff. Maybe I don't have enough money to buy the stocks or the bonds, or in this case, maybe I want to buy T-bills and I don't have enough money to buy T-bills. Well, a bank might take a lot of people's money together, buy treasury bills with it. That would be a money market fund. When you hear money market funds, almost always they're buying T-bills. There may be some CDs, maybe, or some other things, but almost always it's money market funds are treasury bills. All right, so that's cash. It's easy. You want to invest in cash, just go find the one that pays you the most interest and you're done, right? Because you know it's not going to go down in nominal value.